So we are going to use the transactions that will hopefully look familiar from the Chapter 1 lectures to now start to put all of this into some context that will then result in financial statements. So the first thing that we're going to do is, if we're the bookkeeper, the accountant, or whatever, somebody's going to come in and bring us a source document. That could be a check, that could be a receipt for somebody that bought something, that could be a purchase order, it could be anything. And so we've got this document and we think to ourselves, okay, this has to impact at least 2 accounts. It could be more, but at least 2. So which accounts were impacted by this transaction? Now that I've decided which accounts were impacted, how were they? Did this transaction make the balance in the account go up or down? Because that will determine whether or not it's a debit or a credit. And so we're going to record these entries, and then in a general journal, which is a transaction by transaction ledger. And then from there, we're going to post them to the individual ledgers for each account, so that we can keep track individually of the balance in our cash account, for example, or our accounts receivable or something like that. Now, I want to preface all of this with the fact that it is unlikely that anyone actually does bookkeeping like this any longer. With the advent of computers and software, all of that stuff is going on behind the scenes. And why we teach this to you is so that you know you're not just pushing buttons and entering stuff blindly, because the computer is only as smart as the person entering the data. And if you don't understand where things need to get entered and why, I can tell you that I have seen accounting files brought in by clients who just put stuff in, and if they hit enter and the transaction was saved, they assumed that the computer was smart enough to figure out whether the transaction was saved in the proper way, and that's simply not the case. So you have to know where you're putting this in to ensure that it actually gets recorded correctly. And with that, away we go. This journal that I talked about, this is going to be a chronological listing of our transactions. It will have the date, and we always list our debits first. So debits come first, credits are, there's a little indent for credits, and so you'll see we've got debits and credits, and our debits and our credits for each transaction must equal. And then we'll also have a little explanation for what the transaction is specifically. We then, again, it's not enough to be able to just record the transactions in chronological order. We need to keep track of the balances in our accounts. So here's an example of the ledger for our cash account. And so we've got our debits and our credits to cash, which symbolize, cash is the money, the debit is the money that came in, and the credit is the cash that went out. And then we've got a balance here at the end. And just to illustrate how that flow goes from the journal to the ledgers, this slide talks about it. Each account is, in that chart of accounts, going to likely have a number. Not always, but it depends on whether or not you elect to do that in your computerized accounting system. But back in the day when accounting systems like this were first developed, these accounts were listed by number. So you'll see, for example, we've got the cash account here that is account number 101, and our C. Taylor Capital account is 301. When we record from the general journal into the ledgers, we're going to, in this little PR, which stands for posting reference column, indicate that it was recorded, the account number that it was recorded in. And this says to anybody who comes along later that the journal entry was subsequently recorded into the ledgers. And because what you don't want to do is forget, and then what happens is you think you have more cash than you really do because somebody didn't record a transaction in the cash ledger, and it's bad when you think you have more money than you really do. So just to recap, we are going to look at the source documents and decide what it is that happened, which accounts were impacted and how. And then we're going to record those transactions in the journal. Once we've recorded them in the journal, we're going to update the account balances in each of the individual ledger accounts. And so again, this will be transaction number 1. And if you think back, this was the first year that our company was in business, and or the first month, I should say, that our company was in business. And that first transaction was the investment from our owner, C. Taylor. And he invested $30,000, and in exchange he gets capital, or stock is another way of referring to that, in this company. So here is our journal transaction, and we have a debit for cash of $30,000 and a credit to C. Taylor Capital. Now this little blue part here or I guess it's green, blue, I don't know, up above here, this isn't really part of the entry. This is just to illustrate the accounting equation and the fact that we are still in balance. So we've got on the asset side $30,000 because our cash balance went up, and on the equity side our equity balance increased. Taylor has more equity than he did prior to having made this investment. So we then wander on over to the individual accounts for both cash and C. Taylor Capital and record those. And it's really important that you make sure that you are recording the debit into the debit column on each of and then the credit into the credit column. So what you don't want to do when you're doing homework or inadvertently doing things, figuring things out, is to inadvertently take a transaction that you recorded in the journal as a debit and accidentally record the entry as a credit. And this method of doing T accounts and this double entry, this is a little bit like training wheels. And you will find that even in very complex transactions, very experienced accountants will resort back to this sort of T account approach to just visualize how these accounts are sort of impacted and work themselves out. So it's actually really common to analyze a transaction and to see somebody just mark out some T accounts, because this, for people who are visual in this way, this is an easy way to make sure that everything is recorded properly. All right, so now we've got transaction number 2, and we bought supplies. So what are supplies? Supplies are an asset. What did we use to buy those supplies? Cash, also an asset. So do we have more supplies or less supplies? Hopefully you think, well, we have more supplies. So when an asset is increased, that's a debit. When an asset is decreased, that's a credit. So the other account that's impacted by this transaction is cash. We have less cash than we did a minute ago before we bought these supplies. So when the credit, we need to record cash, a credit to cash, as a result of having now decreased the cash balance. So looking at our individual ledger accounts here, we see supplies as a debit. So we would say, okay, we've got a debit balance in our supplies account of $2,500. And then look at our cash. We started out with 30. That has been reduced by the credit of 2,500. And so we would say our cash balance, we have a debit balance in the cash account of 27,500. And let's move on to transaction 3, which is purchasing equipment for cash. So again, ask yourself, all right, what accounts were impacted? Cash and equipment. What kinds of accounts are those in terms of this little balance sheet equation? Well, they're both assets. And so we have more equipment, so our balance in the equipment account is going to go up, and that is a debit for an asset. But because we spent our cash, also an asset, and the balance goes down, that's going to be a credit. And we will then take those entries over here to the individual accounts, and we will record in our equipment account a debit for 26,000, and in cash a credit also for 26,000. And I think that probably leaves us with about 1,500 in cash left over, if I'm doing the math correctly in my head. All right, transaction number 4. We've purchased supplies on credit. So accounts that are impacted, supplies, but not cash this time because we bought it on credit. So we owe somebody now. And when we owe somebody, and specifically we owe a trade creditor, that's going to get recorded in our accounts payable. So our supplies have gone up, that's a debit. Our accounts payable has also gone up. And I don't unfortunately have that little chart handy, but if you do, take a look at those liabilities, look at what increases and decreases a liability account, and you will see that opposite from assets, a credit increases the balance in a liability account. And we remain in balance from this transaction. We have 7,100 and 7,100, so that's in balance, and we are good to go. And I should note that our supplies account currently has a $9,600 debit balance. All right, we provided some services for cash. We have services, we have cash. What's another name for services? Could be income, could be revenue, could be, we could specify more specifically what types of services if we really wanted to break it down. And in this case, we call it consulting revenue. And that falls over here under the equity side of things. And so because we got paid, we got cash, cash is an asset, the balance went up, that's a debit. We got consulting revenue, the balance in the consulting revenue went up as a result of having earned that money. And when the balance in a revenue account goes up, credits will do that. And so we then take those entries and we record them. I'm not going to try and figure out what the balance in the cash account is at this point, but you can do the math. Add up your debits, subtract your credits, and that gives you the balance in the cash account. Meanwhile, we just have our lonely $4,200 credit balance in the revenue account. Better earn some more money quickly. Now we're going to pay some expenses in cash. So, cash and expenses. We've got rent expense that we're going to pay of $1,000. An expense account, a debit entry increases the balance in an expense account. And we've got less cash than we did before. We know that a credit entry will decrease the balance in an asset account. And So we remain in balance, we wander on over to the individual accounts, we record those entries, and then we move on to the next transaction. And I see I'm right at about my 15-minute mark here, and I'm only about halfway through these transactions, so I'm going to stop this recording here, and we will wind up the transactions on the next video.